Good morning. It's Monday, August 12th, 2013, and I'd like to welcome everyone to our live Ask the Analysts webcast today. My name is Chris Grams. I'm with CME Group, and I'll be moderating this morning's discussion. We're starting a few moments late this morning and actually changing things up and starting at 8 o'clock. Moving from our 2:30 time previously and moving the crop report panels, the discussions to a day of USDA report. So with that in mind, we've invited two grain experts to provide their outlook ahead of this morning's USDA 2013 crop production and WASDE reports. But before I introduce them, I do want to remind everyone who's joining us live online that you can submit your questions in the question box on the lower right-hand side of the webcast screen. So please do begin submitting those questions for our experts now. I want to also note that an archived version of this panel will be available later on the CME Group YouTube channel. That's youtube.com/CME Group TV. At this point, I'd like to briefly introduce our experts. On my far left, at the end of the table, Dr. Bill Tierney, Chief Economist at AgResource Company. Bill has more than 30 years of experience researching, modeling, and forecasting commodity prices for wheat, feed grains, oils, and biofuels. And as Chief Economist for AgResource Company, Bill and his colleagues provide market information, research, and strategic consulting to farmers, elevators, soybean and corn processors, wheat millers, food companies, trading companies, importers, exporters, meat packers, and others. Prior to joining AgResource Company, his experience includes working as an analyst for Pillsbury, as a professor of K-State University, as a principal grains economist for the USDA, and as a researcher and economist for brokerage and international agribusiness consulting firms, among others. Directly to my left, Jerrod Kitt is Director of Research for Linn Group, specializes in biofuels research, and regularly provides general energy, financial, and grain commentary. Jerrod is also a regular contributor to these crop report panels. And with that, I'd actually like to ask Jerrod to start us off with some discussion of corn and what we're likely to see today. Jerrod?
Thank you, Chris. First of all, I'll just be kind of covering the corn market and what a difference a year makes. You know, I don't think anybody would have guessed we would be here where we are this year, just a year after the devastating drought that ravaged crops last year. But here we are. We've seen a remarkable bounce back in a lot of these states, particularly in the Eastern Belt. So first and foremost, this is a very important crop report. This is the first kind of objective look at the corn crop. The USDA does a stalk count times an average weight and gives kind of the first glance at the corn yield for the year. And really over the last month, the ideas in the trade of the corn yield have just grown substantially. And we're in that camp as well. In the last report, the USDA gave us a 156.5 yield. The Linn Group recently projected the crop at 157.9. It's important to note, though, that in this report, the USDA does tend to be conservative, but the reports from crop scouts on the ground are that the stalk counts are just off the charts in a lot of these areas, which could unduly influence the yield this year. And the market's clearly aligning for kind of a bearish report here. Now, looking at crop production, we feel that the Eastern Belt in particular is going to carry the day. And when you look at Illinois, Indiana, Ohio, these state yields are going to be 10 to 15 BPA above record. We do a little bit of a map that kind of details this year's versus last year's crop estimates, and it's just shocking the year-over-year increase in some of these states. Just glancing at this, Illinois up 80, Indiana up 81, Kentucky up 102 BPA. Now that's our expectations versus what the USDA had last year. So we've seen a very big potential rebound in this crop here. The Eastern Belt's going to carry the day. Now it's important to note that not everything is perfect. You've got a major dry area in North Dakota that might lead to a year-over-year reduction in yield, which is kind of surprising. And kind of one of the big problem states is our major producing state of Iowa. The northeastern part of the state looks pretty good, but a lot of the crops in the west and the central part are just barely hanging on. What's really helped this year is the fact that you've had very cool temperatures, which has reduced your heat stress, reduced evaporation rates. But at the end of the day, this crop still needs rain. So our kind of view on this, on the market right now, is we do want to effectively sell rallies, But the market's probably baked in a little too good of expectation in right now. It's probably a little too early to put the market to bed. There's a lot of stories kind of emerging as we get down to these lower price levels. One interesting thing that happened, of course, is the Cargill ban of the additive Zilmax in cattle feed. That could add an extra 50 to 75 million bushels to feed demand. The ethanol industry should see a rebound this year in production, but that still seemed fairly limited due to the blend wall issue. We don't see demand increasing much beyond 5 billion there versus 4.65 projected at present. Kind of the big sticking point, though, really is exports. Even at these lower price levels, 450 D's corn futures, we're looking at an export program that's still 20 to 25 cents a bushel uncompetitive versus the Black Sea and Brazil. And that could be a problem going forward. So in conclusion here, you've got the market expecting bigger yields than the July number, bigger carryouts, and it better get it because the market is leaning very, very short. And that means not just the large spec, the funds, which is well publicized, but we feel that end user coverage at this point is not that good. They're very, very patient, waiting for lower prices. So this could very well be enough for a minute, but I wouldn't be surprised if we maybe test a new low post-harvest of $4. There's still enough question in this market to not quite put it to bed yet.
Thank you, Jerrod. Bill, have you talk a little bit about soybeans and what we're expecting today in the USDA report?
Okay, Chris. A little bit of background based on one of the news services that conducts surveys. The average trade expectation for soybeans is 3,336,000,000 bushels for soybeans. That's down about 80 million bushels or 2.2% from what the USDA's World Board projected in their July WASDE. USDA is projecting a record yield of 44.5 bushels. That is the first time that the USDA in their July WASDE has ever projected a record yield. And the trade is kind of like they're acting like they're from Missouri. It's like, well, you got to show me that yield before I'll believe the yield. So we're kind of in that camp. We're looking for the August crop report to show about a 43.5 bushel yield. We note that it is very, very difficult to come up with a survey-based estimate of the soybean crop this early, particularly with the delayed crop the way it is. Some crop scouts have even made the comment that we shouldn't even conduct a crop estimate in August for soybeans because there's so much variability, there's so much weather left. Speaking of weather that's left, a number of crop analysts and crop meteorologists have taken a look at weather patterns this year, how the crop has developed so far this year, and looked at past years. And in particular, 1974 seems to pop up in a couple of people's minds. In 1974, there was a freeze in September. The final crop for soybeans was down over 6% from what the August estimate was. There was also problems with regard to the quality of the crop that was harvested. So there is some concern that this year is a little bit unusual in that there is a bit more production risk that remains in the growing season. On average, the August crop estimate comes in within about 1.6%, or actually about 2/3 of the time the August crop report comes in within 1.6% of the average trade estimate. Rather than talk so much about what the U.S. crop is going to be, I'd like to focus the audience's attention on what the rest of the world's crop is going to do. Each year that's gone by, the U.S. represents a smaller and smaller share of the total global soybean supply and the global vegetable oil supply. It's estimated that for this upcoming crop year, exports of soybeans and soy meal from Brazil and Argentina, the number 2 and number 3 largest soybean producers, their exports will be 70% larger than our exports. So even though This year, the U.S. still remains the world's largest soybean producer. Perhaps next year, or certainly the year after that, Brazil will become the world's largest producer. And more important than just production is how much do those countries contribute to the world exportable supply. Currently, as I said, they're expected to export 70% more beans and meal than the United States does. So while it's important to focus on the August crop report, it's another data point. That data point is much less important than it was 5 or 10 years ago. Lastly, in terms of what does all this mean for prices, this is a chart which shows the change in November soybean futures prices about 1 week after the report. As you can see, there's not a very good relationship between the change in price and whether or not the report was a surprise or not. The bottom axis shows how much the report deviated from expectations. The chart here shows how much the futures did. There's a very poor fit. What that says is that the market's response a week from now is far more influenced by ongoing weather, demand considerations than just what this report says. So there's a lot of production risk left in the market. There is a lot of uncertainty left in the market, and our own price models suggest that if we do get up to the USDA's projection of 44.5 bushels, we could see as much as $1.75 lower November soybean futures than where we are today. We're not forecasting that to happen in this week's report, but if we do get up to that 44.5 bushel yield, then the downside risk in the soybean market is about $1.75 from where we are today. Thank you.